Hey guys, hope you're doing well today, and welcome to the next masterclass for option strategies. So we have butterfly spreads today, which I get a lot of questions about. Obviously, you guys have seen the recent wins we've had with Palantir, Microsoft, and Amazon. I'll go over a lot of different strategies here because there are four different variations of butterfly spreads. Important to understand the nuances behind them because obviously these are very, very nuanced strategies to use. You need to know when to use them and why to use them and how wide to go and all that stuff. So we'll dive right in, okay? So first thing is the agenda. So foundations, what is a butterfly overall? Metrics and Greeks, max profit, max loss, break evens, the risk profile, the different variations of butterflies you can use, and then putting all this information to work as well. If you have any questions later on, obviously drop them in the comments below and I'll reply when I can. So what is a butterfly spread? How is it built? And what is the payoff profile overall? Well, a butterfly spread is a three-strike defined risk option strategy that profits when the underlying asset finishes near a target price. Combines basically a bull spread or and a bear spread in the case of a butterfly call spread overall, right? So you have three strikes, one position, which is the entire position overall, equal distance between the lower, middle, and upper strikes, which is a standard butterfly. You're going to have a 1-to-1 ratio, meaning you're going to buy one lower strike in the case of a butterfly call spread. If it's a put spread, obviously, it'd be the opposite of this, but we're going to use a call spread for our example here. So you're buying one lower strike call option. You're selling two middle strike call options, so a bit higher than the first strike, obviously. And then you're buying one more call option above the middle strikes, all same expiration. Obviously, all calls in the case of a butterfly call spread, all puts in the case of a butterfly put spread. And you typically want to have them equidistant from one another. So, for example, if you buy a $100 strike call option, you sell the 110, that's $10 wide. What would you do next? You would then buy the 120 strike call option to hedge out the risk of the middle strikes overall. Um, the nice thing about the strategy is it has limited risk and reward and often provides very, very good asymmetry of risk to those that know how to use it well. The loss is capped at the net debit paid. Profit is capped at the middle strike overall. So one thing to note here, you never want to target maximum profit because typically you will not make maximum profit on a butterfly call spread overall or put spread. You want to target perhaps, 2, 3, 4, 5x of the position, depending on how wide you go and how far to the money you go. But targeting the maximum profit is a fool's errand. Do not try and make the maximum profit. You will be disappointed typically most of the time because that would require that we land smack dab on that strike price at 4 p.m. on the expiration day and then hold into after hours as well. Um, Typically, a butterfly spread is used as a bet on low movement, right? It'll reach its maximum value if the underlying asset pins the middle strike at expiration, right? So direction it can be neutral or bullish or bearish, depending on how you use it. The risk is defined. Debit paid is the maximum loss. The reward is also defined as well, which is the spread width from the middle strike to the lowest strike in the case of a butterfly call spread, minus your debit amount. That's your maximum upside overall. Um, Ideal market, lower volatility, range bound, perhaps. Time decay works in your favor. And again, it's four contracts, long one, short two, long one. So here's an example. I'm going to use a basic example. I toyed with the idea of like sharing the Palantir, Amazon, and Microsoft strategies that we used. But I thought, you know what? We're using hindsight bias to kind of express that this worked out these times. I don't want to do that. I want to show what happens basically in a base case example, right? So a butterfly call spread here, let's say, for example, we have an asset at $100 per share, and you think it's going to pin that price of $100 per share. What can you do? Well, you can buy a 95 strike call option, sell two of the 100 strikes, and buy one of the 105 strikes. Therefore, it's a $5 wide butterfly call spread where the middle strike is currently at the money, basically betting that we're going to pin this current strike right now, right? So you're betting that spot price will stay the same essentially into expiration. And in this case, there's a debit cost of $1.50, which means that your maximum upside is $5 minus 150, which is 350 maximum profit, right? And you'd have two break evens in this case. You have one break even from the lowest swing, which is 95, plus the debit amount, 150, therefore it'd be 96.50. And the second break even would be the highest strike minus the debit amount, right? Which in this case would be 105 minus 150, which is 103.50. Um, Here's kind of the payoff profile of how this would look on a chart visualized, right? So notice that if we land at expiration in the middle strike, that's where maximum profit resides. And as we go out of the money, you get maximum loss basically below 95 and maximum loss above 105. So it's the same outcome, which is a bad outcome, obviously, if we expire out of the money or past all three strikes as well. The exact same outcome overall. But again, this is a defined risk strategy overall, and there are two different break-even points. So not to fret about if we push above the middle strike, for example, because there's a second break-even point toward the upper strike at 105. The next thing is key metrics, right? So you have maximum profit, middle strike minus lower strike minus net debit. That gives you your maximum profit. So in this case, you'd have, for example, 100 minus 95, which is $5 wide, minus your debit cost of 150 equals 350. Maximum loss, again, is the debit price paid. 150 is your maximum loss. Lower break even, again, is the lowest strike plus 150. Upper break even is the upper strike minus 150. And again, you can structure these trades any way you want. You can go wider, narrower. It really depends on your desired asymmetry of risk, as well as what you think will actually transpire into the expiration date as well. How the Greeks perform overall, right? So important to understand how this affects the Greeks. Well, for theta, time decay, it's positive because essentially you're short two contracts that are at the middle strike. Typically, you're going to get more time decay on those contracts than you're incurring on both of your long strikes overall. For volatility overall, it's not really positive because essentially you're short two middle strikes again that will have higher vega values. And if we push toward that middle strike, what happens is the at-the-money options will expand at a faster rate than the in-the-money option that you already have, because it'll trade, at a higher delta overall. And the out-of-the-money option contract will also trade at a, lower vega value because it's out of the money as well, right? So at-the-money contracts typically trade with a higher vega value. It's kind of like a bell-shaped curve where the middle of the bell, which is spot price, will have the highest vega values overall, right? And vega is correlated to implied volatility, wherein as implied volatility rises or falls, all the values of options will rise or fall based upon their vega values. Every 1% increase in IV correlates to a plus or minus, or sorry, I guess in this case, it'd be a plus if you're increasing IV by 1%. Every asset price or option price across the option chain will increase by 1 times the vega value. So important to note as well. Delta, it's somewhat neutral overall. If you add up all the different deltas on an option chain for a butterfly spread, you can see what the overall net delta exposure is. But it's usually roughly flat if you're building the structure properly overall. So it'll basically elicit not much movement until we move toward the middle strike. So if we're out of the money, that's usually the best case scenario because you have the cheapest overall cost to the trade. As we move toward the middle strike, you're going to see an increase in the value overall. There are different variations, right? So again, as I mentioned, there are many variations of the strategy. There are long butterfly call spreads, long butterfly put spreads. So again, this is where you're bullish, perhaps targeting the middle strike, where you're short two contracts. There are long butterfly put spreads where you're perhaps bearish temporarily, where you're also short two contracts at that middle strike target. There's a strategy called an iron butterfly, which is very interesting to use as well. This is where essentially you're selling the middle strike on both the calls and the puts, and you're basically shorting a straddle at the middle strike, and you're buying a strangle. So you're buying out of the money wings, and you receive a credit. And the idea is that basically you want the underlying price to stay as close to the middle strike as possible into expiration because that will elicit profit overall. But you need to buy it back at some point in time as well. Finally, we have the broken wing butterfly, which is where you have uneven wing widths overall. So you might, for example, say, okay, you know what? I think that we're going to see an upside push on a given name. Current price is $100 per share, but you're not sure how high it's going to go, right? So maybe you buy the $100 strike, you sell the 110s, and maybe you buy the 115 instead of the 120. Thereby, you have a $5 wide net spread on the upside from 110 to 115, whereas you have a long call spread from 100 to 110. So you'd be long 100 to 110, you'd be short 110 to 115 overall. So again, uneven. That's called a broken wing butterfly, right? You use that when you're uncertain of how far a move we're going to get. And again, it'll cost a little bit more perhaps, but it's important to look at the overall cost structure of the trade by just toggling in your option chain and strategy builder and seeing what the net cost change is overall, right? So like, yeah, I won't go to an example yet, but the iron butterfly, here's an example right here. So like someone asked me today about SpaceX, and that might be a candidate for an iron butterfly because maybe it doesn't move too much. Maybe they have a decent report, but again, it's overvalued, so maybe it doesn't do too much overall in a move after earnings, even though it has an implied move of about roughly 20 points in one direction, right, from 117 spot price. So what you would do is you would sell the at the money call and put, which is a straddle, and you would buy the out of the money wings. In this case, example over here, you would sell the $100 strike price call and put, same expiration date. You would then buy the 90 strike put option, to hedge out your risk of the put option being sold, and you'd buy the 110 strike call option again to hedge out your risk of the call option on an upside move. And so essentially, you're combining two different strategies: a call credit spread at the money and a put credit spread at the money, right? Given the same strike, it's a short straddle plus essentially a long strangle, which is owning the wings overall, right? So if you buy a strangle, again, a lot of verbiage here. I don't mean to confuse it all, but again, it's second nature to me overall. But the way you got to think about it is you're capturing credit by basically saying, I believe the market is overpricing the straddle, but at the same time, I do not want to incur unlimited risk in the event that I'm wrong and it moves big in one direction. So what are you doing? You're selling the at the money straddle and you're buying the wings to cap your downside. And this will give you a credit overall. What you want to do essentially is watch the position move toward expiration near the spot price. And as time decay kicks in, the credit will diminish in value, allowing you to buy it back for a cheaper cost overall. Right. So in this case, let's say you got a credit of $6. If it pins $100 per share, in this example, that's your maximum gain, but your maximum loss would be what? $10 wide width from 110 to 100, or from 90 to 100, for example, minus the credit received. Therefore, your maximum loss would be $4 overall. So in this case, you have two different break evens, 94 and 106, right? The body plus or minus the credit overall. In the case of a broken wing butterfly spread, as I mentioned before, you would have perhaps a long $100 call option, short 2x of the 105s, and then long of the 115s. When you do it like this, where you have an imbalanced butterfly or a broken wing butterfly, where the credit position of the trade, in this case, it's the higher strike spread from 105 to 115. When that's wider than your debit spread of 100 to 105, you have more risk on the position overall. It'll make the position very cheap and very appealing, but there will be a lot more risk attached to the position as well. So you need to be cognizant of this, because ultimately, if it overshoots, you can lose more than a normal butterfly, right? So keep that in mind as well. Beyond that, putting this to work, right? So market conditions, a given trade that we have, active management, and the risks to respect. So when to use a butterfly? When you expect the underlying asset to stay near a certain price, this is when you're essentially selling the butterfly middle strike at the spot price, right? IV can be elevated and or should be elevated and is likely to fall. So again, before an earnings event, what happens? Implied volatility elevates. Post that event, what happens? IV plummets, right? So you want to pretty much take positions that benefit off of this contraction in implied volatility. Again, this is one of many strategies you could use for such a thesis overall, but we're talking about butterflies here. So the benefit, again, would be that the middle strikes, which are relatively more expensive than the at-the-money strike or a little bit out-of-the-money strike, for example, those will decay at a far more rapid rate than your long strikes overall. The last thing is you want to define risk, low cost, neutral position, right? And there's a clear pin candidate. This is where you want to look at, for example, implied moves based upon the straddle price, which we use with, again, Microsoft, Amazon, and Palantir, right? These kind of tell us where we possibly go on an upside move or a downside move and gives us an idea of how to use a certain structure to benefit off of that thesis overall. Now, when do you want to avoid these trades? When you expect a large directional move in another direction, perhaps, right? You want to avoid these trades. When IV is low and likely to rise, because again, what'll happen here is essentially that the middle strike will increase at a greater rate than the out of the money, and the like further out of the money strike and the closer to the money strike as well. So that will actually influence your position to decline in value when it happens. So you want to be looking at IV when IV is elevated. Again, if you pull up an option chain and look at the HV number, HV metric, historical volatility, look at the IV metric, you want to see that the IV metric is higher than the HV metric. And ideally, look at the IVP and IVR as well, which are IV percentile and IV rank. I won't dive into that today because we don't have time to do that. But again, read up on IVP and IVR, important to understand as well. Liquidity, you want typically for it to be very, very heavy. So when an option chain is very, very thin in terms of liquidity, you want to avoid the strategy because again, four legs mean four spreads to cross. And so by doing four different contracts, the overall slippage you're going to incur will eat away at your potential profits overall. So you want to avoid any option chains that have lower volume in their option chain, which equates to wider spreads across each strike price overall. And typically, you want to avoid this when you need to hold through a binary event with gap risk. So even though we've discussed, Palantir, Microsoft, and Amazon the past couple week and a half roughly, these are binary events which we're benefiting on by the asset price moving toward our middle strike, right? But again, I've expressed numerous times that if we move away from that in the opposite direction, for example, those positions go to zero right away, essentially. So typically you want to be cognizant of the binary event, understand the implied move, have a directional bias if you are going to use this through a binary event, and understand your asymmetry of risk, and then obviously manage your risk very well as well. Very important. So here's an example of a trade. Again, just made up example here, right? XYZ trades at $100 per share with elevated IV into a quiet week. You open a 9500 to 105 butterfly call spread. What do you do here, right? You buy one of the lowest strikes overall. Debit cost is 620. You sell two of the middle strikes, $100 strike call options. 2x times 310 is 620 credit. So it washes away your debit cost of your first contract right there. And then finally, to hedge out your risk and not have unlimited downside in the event of an upside move in the asset, you need to buy an out of the money call option to complete the butterfly position. So what happens here again, your net debit cost is $1.50. Your maximum profit would be $3.50 then, right? So you're risking 150 to make 350 overall. Management and adjustments overall. So one, taking profits early. If the position increases in value before the binary event, typically like an earning event, for example, or an FOMC, you want to typically de-risk your position a little bit because the asymmetry of risk worsens as your P&L improves. So let's say, for example, in the case of, $1.50, $5 wide butterfly call spread, it goes from 150 to $2 now all of a sudden, right? Well, now you're up 33% already, and you have $2 at risk to make $3 profit. Perhaps the proposition isn't as good anymore as you thought at the onset of the trade, right? Especially if there's a binary event between now and expiration. One of my rules that I love to follow is whenever a position doubles in value, you take off half that position because then you do not care about what happens into the expiration. You can allow it to ride longer. And as we know, the best traders typically hold their winners longer and cut losses earlier overall. So when you have winners, the only way to really hold, especially as the asymmetry of risk worsens, is by de-risking your position by cutting half if and when it doubles in value. Obviously, mind the pin risk overall, right? Near expiration with price at the body, small moves will swing your P&L very, very sharply overall. And keep in mind too that if we're at the middle strike well in advance of expiration, typically that forebodes that we will not expire at that middle strike. Let's say we're like 2 weeks away and we're already at the middle strike and you're already up like 100%, 200%, whatever it is. you want to look at perhaps de-risking your position or taking it off and maybe rolling to a new position perhaps, right? Obviously, the example that we talked about in the last couple of days was Palantir. That position we got into for $2 roughly. Today it's trading at around $7.50, almost $8. And we're at the middle strike already, but you should have already taken off half your position at about 250% profit already, thereby not caring about what happens in the next couple of weeks into expiration overall. But you could take it off perhaps and re-roll it to a new position if you wanted to. So as I mentioned here, you could roll your position to recenter it if you wanted to. It just incurs more transaction costs overall, a little bit more slippage perhaps on all the different contracts you're trading because you're closing out 4 contracts, then you're re-entering 4 new contracts, which you're going to close again later on. That's like 3 new trades essentially times 4 different legs, thereby 12 contracts being traded individually across, basically the exit of one butterfly, the entry and the exit of a second butterfly as well, right? But that is an idea you could use if you want to express pretty much further bullishness or bearishness, depending on your position overall. If you're already, have a fair amount of profit on a position where you're risking like 10 to make 10, for example, and you still have a few weeks left, you might want to think about perhaps recalibrating the position if you haven't de-risked already. And then the last thing to remember is respect assignment risk because we're short 2 contracts at the middle strike. If it crosses that strike on the upside or the downside, you do have risk of early assignment on the position, right? And if that happens, it can kind of kibosh your trade a little bit. If you're holding all the structures in place, your maximum risk is still intact. But post expiration, if you do get assigned and you do not close out your position overall, you can have a much larger loss overall than your maximum loss would dictate when you build a butterfly itself. So keep this in mind and be cognizant of this, especially as expiration approaches. If we're above the middle strike on a call spread or below the middle strike on a butterfly put spread. So some common pitfalls and risks as well, right? Narrow profit zone if you're going narrow on butterflies. This is why you want to obviously understand the ranges that a given name that you're trading typically trades in. Look at the weekly ranges top to bottom and see how much a given asset moves, right? If it moves 20 or 30 points on a given week, respect that and don't go with like a narrow, $5 wide butterfly call spread or put spread. Chances are you're going to lose, right? You want to go wider with more time as well, right? So keep that in mind. One rule of thumb too is the more time you have on a butterfly call or put spread, the wider the wings should be. The less time, the narrower it should be. Like 0 day, for example, you can go much narrower, but with more time means wider wings on a butterfly calls or put spreads. And also you want to perhaps look at, thinking about how much could an asset move by a certain time frame? Again, by using the straddle price to elicit an implied move to the upside or the downside. It kind of tells you pretty much what the market is expecting as upside or downside and allows you to perhaps build your structures around that implied upside or downside, right? Keep in mind, given that you're trading 4 contracts round trip, so 4 to enter, 4 to exit, that's pretty much 8 individual trades, eight legs overall. It's pretty costly for smaller accounts. So there is commissions and slippage to consider as well, right? Look at volatility, right? You want to look at typically IV when it's near a peak or already kind of topping out. Typically before a binary event, wherein after the binary event, we'll see a plummet in IV, which will cause your position to, obviously, if it moves away from that strike, your middle strike price, to lose value, but it won't lose it at a crazy rate versus if you're, for example, building your structures when IV's lower and that expands, you'd be operating at a loss before a binary event perhaps, right? So keep that in mind as well. Look at IV and compare it to HV as well. And as I mentioned, read up on IV percentile and IV rank as well. Next, remember early assignment risk. If we go above the middle strike in the call side or below the middle strike in the put side, be cognizant of this, right? Oversizing, right? Cheap debit doesn't mean you go and you size, like 1,000 contracts, right? Size your positions at all times to maximum loss. I always say, whatever trades I'm taking shorter term, I'm willing to let them zero out, meaning that I'm okay with the outcome if and when they go to zero. Therefore, I invite you to use the same kind of risk management process wherein you accept your risk, whatever risk you take is your risk and your risk alone. And essentially you say to yourself, In the worst case outcome of this trade, I'm okay with that outcome. If it's zero, that's totally fine, right? Mentally prepare yourself for a loss in advance. When it comes, you won't be surprised. Next thing is holding for too long, right? Chasing the last dollar into expiration usually causes you to lose money. So remember, as our P&L improves, our asymmetry of risk worsens. In the case of Palantir, for example, we started off $2 risk to make $18 roughly. Now we're at about $8 almost in our pockets with $12 upside further, right? So think about this as the P&L moves dynamically, right? You should not consider just your original investment. Consider what you already have in your pocket because ultimately, that's profit that's in your pocket right now. If you consider only original investment on a long time horizon, you'll make bad decisions that will elicit typically worse outcomes for your P&L overall. So key takeaways, just to summarize again, butterfly spreads are risk defined, reward defined, and they're a bet that essentially we're gonna land near a given target price, which is the middle strike. The build is again long one, short two middle strikes, long one across three equidistant strikes, all same expiration and type. Maximum profit is at the middle strike. Maximum loss is capped at the net debit cost paid, right? This will profit from time decay and falling volatility, long theta, short vega overall. Iron and broken wing variants reshape the credit and risk and directional tilt and deploy this typically in calm range-bound markets and take profits before pin risk builds overall. I like to use these again with when IV is very high into binary events because asymmetry of risk is very, very good overall. But remember that binary events come binary outcomes. You can lose whatever you put in overall. So accept your risk before you make a trade. Don't do it afterward and then be disappointed by the outcome if it goes against you, for example, right? That's basically it. I will end it here. If you have any questions at all, drop them below. And thanks for watching. We will see you guys next week as well.